It's absolutely true that as companies expand abroad globally, they're confronting more and more stakeholders with more and more diverse histories. And those stakeholders impact their ability to drive profits, to drive revenue growth in more and more ways. We're increasingly aware of that. We're increasingly aware of the importance of stakeholder engagement, but we don't yet have a science for how we turn that risk and that opportunity into a strategy. We have exhortations to do more, to be better. We have claims that there are enormous risks, and we have horror stories of billion-dollar capital write-offs. But how much is enough? And which lever should we pull? Who should we talk to? What should we say? Those are the kind of questions that I get confronted with as a professor at Wharton. I've been here for 16 years, and I've been teaching a course on these topics. And over the years, as my students have challenged me, and also as I've engaged with corporations through my consultancy, Prem LLC, I've been confronted not just with the academic argument that this is important, and increasingly so, but also with the practical question of what do I do about it? And over the years, as I developed more material and more tools and more structure, I tried to put it together into this book called Corporate Diplomacy. And what it is very much a toolkit. It's a how-to book for managers like Bennett who understand the importance, but they want to know how much is enough. And maybe they're confronted with a CFO who's less sympathetic or a CEO who's a skeptic. And they have to prove the case, not with words, but with the same hard-edged, rigorous analytics that the CFO, the COO are going to come in with. And that's what corporate diplomacy is about. So let me shift over, if I could, with that into the presentation. And I'm going to try to work through the broad overview of the book, Corporate Diplomacy, but along the way tell some stories of people like Bennett, who drove value and drove revenue growth because of their ability to manage it, or who created risks and liabilities because of their failure. At the end, I'm really looking forward to the questions that come in from Lauren, from Bennett, from others, because I'm always interested in learning more and continuing to push out the frontier of corporate diplomacy. So let's start with a project. A project could be a gold mine, an oil and gas field, that someone's considering investing in today. And they're going to have to invest hundreds of millions of dollars over the next 2 or 3 years before the project generates any revenue. And once it does, it's going to take some time before it pays back that initial investment due to depreciation. And this is the financial plan that maybe a finance team, an engineering team came up with, and it's a pretty high value, strongly positive net present value project. There's going to be some cleanup costs or some remediation at the end, but this still drives, this still looks like a really good high profit project. The problem is this isn't reality. The reality is that this project has environmental externalities, social externalities, political concerns that are going to require changes, that are going to generate opposition, that are going to generate real problems in execution. And so the reality is one of two realities. There's a chance that the protests are going to get so large, there's going to be such controversy, there are going to be so many roadblocks, so many protests in front of the presidential palace, so many riots, that the project's going to be abandoned after a couple $100 million of investment. And maybe, if they have really good lawyers, about 20, 10, 15 years from now, there'll be some compensation for some of the lost investment, but that'll be heavily depreciated. And that'll lead to a pretty substantial loss. On the other hand, if they invest a little bit more in environmental remediation, in redistributing the rents to local workers, creating more local businesses, demonstrating the value to the local country, it's possible this will still be a very profitable project. But they're going to have to invest more up front, and they're going to have to live with a lower revenue stream, and every once in a while there's still going to be a protest, there's still going to be a concern, there's still going to be some changes that are required. And so the the choice is not really how do we get the purple scenario cash flow line, but how do we avoid the red and try to get to the gold. The further complication is a couple years down the road, there's going to be a new CEO. They tend to last 3, 5, 6 years, and that new CEO is going to say, wait a minute, I thought that we were, we had a way of dealing with these risks. I thought we had a way of addressing these challenges. how much is it really going to cost? And the question is, can we avoid the red, do even better than the gold, but can we invest in political and social relationships that'll generate something more? Is there some way that we could get up to the green or even the blue scenarios, which have lower and higher investments up front, but lower losses in the future and more profitable investments? Sorry, as I was saying, sometimes there's a new CEO, and he comes in and says, wait a minute, why are we back up on that purple line? Why is it that we fell down to the green or the blue? What happened? And he might cut the whole payment system or cut the whole strategy for local employment, trying to get back up to the original plan that the engineers and the financiers had, thinking that all the investments in environmental remediation, political and social capital are just philanthropy or just looking good or just not worth it. And we need to provide the tools that highlight the difference between the overly optimistic scenario, the realistic scenario, and the scenarios that will occur if we don't make the right investments. That's what corporate diplomacy is about. Now, that's the financial toolkit, but sometimes it's easier to tell it through the lens of a story. And I'd like to turn to the story of two managers from a DC-based firm, actually, American Electric Services, that was once the largest global provider of electricity. And they expanded into the Republic of Georgia. And the manager, the general manager in charge of that expansion, was a man named Mike Scully. He went in with a wildly optimistic financial plan, kind of that purple scenario, and he confronted the reality that 90% of the people in Georgia weren't actually paying for their electricity. There were illegal lines everywhere. The government wasn't paying them for the fuel. There were all sorts of complications, and Mike was trying to roll with it. He was trying to build up a communication strategy. He was confronting the government. He was out in the streets arguing with people, but he was losing money. He was losing thousands of dollars an hour or a day, turning a $30 million investment into one that was over $180 and then $300 million as he purchased generating equipment instead of just the original distribution facility, as he subsidized low-income payers with the help of the USAID and the European Bank for Reconstruction and Development. But it was going to be a while before Mike could turn it around and generate positive cash flow. And unfortunately, as the story I just told you on the financial side, Mike didn't have enough time. And he was replaced with a hard-edged Venezuelan manager, Ignacio Iribarren. Ignacio looked at the communications budget and said, that doesn't generate revenue today. He looked at the subsidies. He looked at the assistance of the World Bank and said, that doesn't generate revenue today. We're going to turn this business around, thought Ignacio. We're going to focus just on the finances and on the things that generate short-term cash flow. When he did that, he made enemies. And the enemies led to increasing violence against AES employees and increased pressure on AES to leave, culminating in the execution of the CFO of an American publicly traded company in the Republic of Georgia and the sale of AES Telasi to the Russian gas company for negative $30 million. They paid the Russians $30 million to take a $300 million investment off balance sheet. What's the moral or what's the lesson of this story? Mike was all heart. He came in a little naive, without the right model, but he tried to adapt, and he was making the investments, and he was slowly turning the business around, but he could never justify those expenses to headquarters. He could never justify them to Wall Street. He just had the intuition they were the right thing, and he didn't have enough time to pull it off. Ignacio came in and was all about what he could prove using financial models today, and none of the political and social investments Mike was making looked worthwhile, but he actually destroyed value by cutting them all. So we need to find something in between Mike and Ignacio. So I'm going to combine Ignacio's financial acumen with Mike's softer skill set. What does that look like? It's called corporate diplomacy. It's a combination of analytical, data-driven information on stakeholders and financial models, together with behavioral, softer skills, some focused inside the company, some focused outside the company. And what I want to do over the next 15 minutes or so is walk you quickly through what I call the 6 elements of corporate diplomacy. Starting with due diligence on the stakeholder landscape. We do due diligence on the geology, the hydrology, the electric system, the engineering system. What about our political due diligence? What's the frontier there? And then how do we turn, the next element is integration. How do we turn the data we have on the stakeholder environment into something we can use for financial analysis? Not keep it separate, not keeping it down the hall or in a cubicle, but really bringing it into the core business systems of the company. Next, once we know what we want to do, which stakeholder we want to reach out to, which issue, how do we build trust with those stakeholders? That takes an understanding of the personal relationships and the trust. Next, how do we make sure the system learns and adapts? Because we're never going to get it right. We're always going to have shocks, uncertainties, new events that we're going to have to adapt on the fly. How do we make sure we're getting in real-time data and that we're willing to make a change? We haven't dug in our heels saying this is what we're going to do no matter what happens. How do we communicate to external stakeholders? That's openness. And how do we build an organizational culture that's important, that demonstrates or argues that stakeholder engagement is important? Note that the first two elements are data-driven and analytical. The next four are behavioral. Two of them focused inside the company, two of them focused outside. That's why this is so hard. It's soft and hard skills, internal and external, all that have to be executed together, coordinating the functions of government affairs, community affairs, sustainability, communications, leadership within the organization, adaptive systems. This is not easy stuff, but this is what it takes to succeed on the frontier of emerging markets. So let's start with the due diligence on the stakeholder landscape. What do I mean by due diligence? What data are we going to gather? How are we going to visualize it? How are we going to put it in a structure that we can integrate into core business systems? One technique I use is to look at the media. Or social media for information, because what we want to know is what stakeholders think about us. Here we learn that the chairman of Australian Solomon Gold, a man named Stephen Everett, has praised the Ramsey, the regional forces led by the Australian troops, and the local police, and he's thanked the Solomons government. We can turn that sentence into data. It links the source of the action, ASG chairman Stephen Everett, through an action praising and thanking, which scores a 3 on a conflict cooperation scale, with 3 targets: Ramsey, the local police, and the Solomons government. Here's another one. The president of Kazakhstan, President Nazarbayev, ceremonially kicks off a mine at the Varvinskoye deposit. This is a show of support, a stronger element of cooperation linking the president of the country to the mine owned by European Minerals Corporation. We also have conflict in our media quite often. Mr. Kabila, then a rebel leader of the ADFL group, has ordered to negotiate or see their concessions sold the foreign mining companies Banro, Mindev, and Barrick. That's a -4 on the conflict cooperation scale. And here, Filipino villagers have moved to shut off water, the withdrawal of a critical supply from the gold and copper mine owned by Oceana Gold Corporation. So now we have hard data. Not just text, not just reports, but hard numbers on what stakeholders think about us. The conflict cooperation scale ranges from violent attack with the actual or potential intended death or injury to the provision of armed support and defense, with most of the action in between. And for each item on the scale, we have a whole vocabulary of synonyms, of phrases that mean approximately the same thing, and we do fuzzy matching to see where each sentence falls in that. Now we can go back to one of the core tools in the Stakeholder Toolkit, the 2x2, that plots sentiment on the horizontal axis, who's opposed to us on the left, and who supports us on the right, together with influence or power on the vertical axis. But instead of just sitting around the table and saying, where do stakeholders fall, what should our strategy be, where do you think this person is, where do you think that stakeholder is, we have hard data. And we've done that here for a gold mine in western Romania, the Roșia Montana mine. We've plotted each stakeholder based on the media-reported discourse and media-reported actions that they've taken. Stakeholders from Albernus Meyer, an NGO that opposed the mine, to the Romanian Parliament or the Minister of the Environment. And we've plotted how their preferences evolved from 2003 to 2008. Stakeholders on the left are more opposed, on the right are more supportive. Those that are higher up appear more frequently in the media, indicating that they're more powerful or important. Those that appear lower down are less important, as reported by the media. Now we have hard data on what stakeholders think. We also want to know why they think it. What issues do they care about? Is it land? Is it jobs? Is it contracts? Or is it environmental externalities, like livestock damage, soil and land damage, water access or pollution, dust from the roads, noise from the blasting? We need to array all the issues that drive stakeholder opinions and understand which stakeholders care about which issues and put that information together in a way that it's actionable. We use issue matrices. Issue matrices capture the key issues that stakeholders care about, arrayed from the top of the chart to the bottom based on which stakeholders care the most. So transportation infrastructure is the issue that more stakeholders care about than any others. Land use is next, and then unemployment. Along the columns are different types of stakeholders in that 2x2. Stakeholders who like us a lot and care a lot, those are the cheerleaders. Stakeholders who dislike us a lot and care a lot, those are the opponents. So now we're grouping stakeholders by type, and we're looking at how they care about, or which issues they care about. And that gives us some real insight as to what this company should do. There are 4 issues, the ones at the top, that unite the 2 most important groups of supporters and the 1 most important group of opponents. Those are 4 issues the mind needs to address. There are also 2 issues that supporters don't seem to care much about, water and community infrastructure, but opponents and challengers do. That's a warning sign. That's a set of issues that the company may not pay enough attention to, but should be sure to do so to avoid a swelling of opposition. Another way we look at the data is through network tools. We try to map out the networks that link various stakeholders and understand how they can deal with a challenge. Here, the mistaken information pushed out by radio station B that the mine is responsible for a cholera outbreak. But radio station B doesn't like the mine and won't have a meeting with the mine's general manager. They just keep pushing out the false information. The mine looks at its network of relationships and realizes that it has very good relationships with the National Health and National Fire Service and moderate relationships with the National Police, and they all buy ad time and have better relationships with radio station B. So they use these intermediate communication channels to get to radio station B and get them to moderate their story. So these types of visuals can provide key insight as to who to reach out to, which issues to prioritize, which stakeholders are more important, and then we can take that same information and use it to adapt our financial plan. How do we do that? One example is on the mining study that I mentioned earlier. We figured out what the NPV is of the gold reserves that these mines are supposed to bring to market based on their disclosure documents, and we found something quite striking, that the average mining company we were studying was trading at a 78% discount from the net present value of the gold it was promising it would bring to market. We thought, can we explain that? Could it really be that investors are discounting the mine by 80% because they think stakeholders will get in the way? We found that was actually true. Here, what I'm plotting, the dark line, is the discount from the resource valuation that investors are giving each of these 4 companies in terms of market capitalization. And the green line is the collection of stakeholder conflict cooperation data from the media. And you see the green line tracks the blue one pretty well. We can explain more of the variation in the value of these mining companies by looking at what stakeholders say or do towards them than we can by the resource value of the gold. We can do that not only at the corporate level, but we can do it at the project level. We can look at those issue rankings. Which issues are the most important? How are those linked to risks on the project level risk registry? And which public affairs, sustainability, or government affairs initiatives are going to address those risks? Then we can do a Monte Carlo simulation, understanding how the financial value or the net present value revenue stream we started the presentation with is actually going to evolve because of disruptions here in the production phase. How often are they? How long will they last? How much do they cost? And how are they influenced by the addressing of a stakeholder or sustainability initiative? We know this is all stochastics. We have to do thousands of draws to get an understanding of the distribution of returns, and then we can assess the net present value of sustainability. What's the ROI on a land access negotiation, on local business development, on health programs? We can provide hard-edged answers using the same models and tools that the CFO is familiar with, instead of just exhortations to do more. Next, how do we build personal trust? Once we understand what are the issues that drive financial value, how do we go out to those stakeholders and actually win their hearts and minds? It's no longer enough just to say, well, this is what's going to make us the most money. We have to build a positive relationship with them, one in which they think we really have their key interests, their key concerns at heart. I use 2 frameworks here in the classroom and in the book. One is one that was developed by a colleague of mine at Northwestern University, Daniel Diermeyer, in his book Reputation Rules. It's called the Trust Radar. And what the Trust Radar highlights is that often managers, financiers are really good at conveying their expertise. We're technically competent. We know how to solve this problem technically. We're smart. We went to Wharton. We went to Northwestern. We went to Georgetown or Maryland. We went to one of the top schools. You should trust us. But the reality is that's only one of 4 elements that help build trust in a personal relationship. You also have to demonstrate empathy. And companies aren't so good at saying they're sorry or demonstrating an emotional intelligence quotient when they're dealing with stakeholders in emerging markets. They also have to be open, having a fence, not allowing people to see the original contract, not allowing people inside the gate. These are all things that make people suspicious or concerned as to whether they should really trust you. And you have to demonstrate that you're there for the long haul and you're willing to put in the time. If you're flying people in and out every few weeks, or if the rotations, even if they last 2 years, you're not really there for the long haul, and people see that. So you have to go beyond technical expertise to demonstrate emotional intelligence, to be open, and to demonstrate your commitment to the concerns of the stakeholder over the long term. If you do all 4 of those, you'll increase the trust space and increase the strength of your relationship with stakeholders. Another thing you have to do beyond trusting them is empowering them. This is actually a model developed in urban housing projects in the United States in the 60s, when they were trying to figure out how they could get people to take better care of their city-owned housing. And at first they started by trying to trick them or provide, treat them as if they didn't really understand what they were doing, or they weren't very smart, and we got to treat you like patients. There's something wrong with you. You won't take care of the house. We got to explain it to you. We got to lecture you. We've got to hector you. And then they started actually listening, moving up what's called the ladder of consent into informing and consultation, really listening. What was going on? What was going on with drugs? What was going on? What was going on in the communities that was causing all these problems? And then they didn't try to solve the problems themselves eventually. They actually let the owners of the housing projects develop their own solutions. They gave the people who lived in the public housing more control over security and more control over maintenance. When they actually ceded control, people started taking better care of the houses. So one of the things that's hardest for companies to do when they're dealing with external stakeholders is recognize that the most powerful way to build trust and build a relationship is to give up your control rights and let the people decide how to proceed. A great example of this I saw once when a mining company was trying to develop housing again for a community around a mine site. And they did the engineering and financial plan, and the best way to build housing was to ship in prefabricated housing from Florida and just pop it up really quickly. It was all modular. It could go up in a couple days, and they'd have these new houses. But the people wanted to use mud and use bricks that they would make locally, and more local jobs and more local workers. It would take a lot of time. It would actually be a little bit more expensive even. But think of the difference when the general manager of a mining company is slapping some mortar on bricks or putting some mud together to build someone's house and working with them for some time. Think about the strength of the relationship that occurs there. Next element is learning. We're never going to get this entirely right. We're going to have to get ways of understanding from stakeholders how we're doing, what are we missing, what do we need to change, and we need to have a safe environment in the company where someone can say, we're doing something wrong. We've actually got to change what we're doing. This is a map of Anglo-Americans' dispute or grievance system, and it tracks how any complaint at the top left that comes in via email, phone, letter, or a meeting is tracked through the system and can generate real change. At the end, there can be real changes in the strategy, real adaptation. Another company that's built a system like this and implemented it is Chevron. And in Chevron's LNG facility in Angola, they went through 7 phases of consultation with stakeholders and tracking their concerns, and they made enormous changes to the design of this project. Changes that increased substantially the time to construction and the cost of the project. But as a result, a project in one of the most corrupt, conflict-ridden, cynical countries in the world has been on the revised timetable and on the revised budget. really striking that they were able to do this, but they did it because they adapted the original design to stakeholder concerns. Two more to go, and then we'll turn it over to questions. Communications, openness. How do we use the communication system, whether it be social media or public media, to reinforce trust from stakeholders? Here, the book goes through an example of the Romanian Mind I've mentioned once or twice before, tracing through 3 different management strategies. On the left, 5 years in which the NGOs defined the project and decried it for the environmental devastation it would create, replacing a pristine Transylvanian landscape. And the company said nothing because they thought the opposition was toothless, wasn't important. Then the NGOs had defined the reality, and the project was stuck. And a new mining executive came in and tried to push back, launched a massive PR strategy highlighting the costs of not going forward with the mine, claiming that the environmentalists were anti-growth, anti-people, and they didn't have the interests of the people of Romania at heart. That campaign smacked a little bit of propaganda, felt a little too much like Ceausescu's communication strategy, and wasn't mated with operations on the ground. A new management team, importantly a Romanian one, has since implemented a strategy in which there's more consistency between what they're doing on the ground and what's being said on television. And they're letting Romanians in Bucharest speak about the importance of getting the $4 billion of revenue that Romania would get from the project. So the new communication strategy is consistent with what's happening on the ground. It's addressing the key issues, and it's using the voices of the people who were thought to be opponents to advocate for the mine. Finally, organizational culture mindset. Every employee, from the CEO to the truck driver to the lathe operator, they all have to believe that external stakeholders are important to the success of the mission. That starts with an organizational mission statement like Novo Nordisk's here, but it goes into who gets promoted, who gets recognized as Employee of the Month, who gets paid more. All these things have to reinforce the idea that external stakeholders matter. Otherwise, someone along the way will trip it up. So those are the 6 elements of corporate diplomacy. Those 6 elements you need to move forward on all of them together. And if you do, you can construct real business value for your corporation, especially in emerging markets. This is an evolving field, one that's never quite done or complete, and I hope you'll continue to track the development of the field through the LinkedIn group and the website in which I try, or the Twitter feed in which I try to convey articles that are coming up on a daily or weekly basis, new tools I come across, and new corporate diplomats like Bennett, who I think we'll turn to at this point.